Welcome to TMS Insights. February reporting has now come and gone. The end of that season was really very busy. There are a lot of reports which we want to go through, Ben, straight away. So let's do this. Maybe starting with a couple of mixed ones in the tech space, in the Australian listed space, Appen and WiseTech.
Yeah.
Really a bit of good and bad, isn't it?
Yeah, I think one a COVID beneficiary, one a COVID hit. So Appen, spoke about the fact that their big five clients, 90% of revenue are in complete lockdown in Seattle and California. They changed some of their spending patterns to deal with some challenges that they've got. So they had a downgrade, but are calling out an acceleration. They're just uncertain about the timing. A lot of businesses we're listening to in the US and Northern Hemisphere, it's the recovery, and the CEOs are all a bit uncertain. WiseTech had a great result.
Great result, yeah. The cargo business certainly
upgraded guidance, and mainly due to all the stuff that's going on in logistics at the moment.
And those things are tailwinds for them. Same things that are hurting Appen, but we see it playing out so differently in a lot of different businesses. Ben, it's better to travel than to arrive. Seek. It always gets clobbered after its result, though, and particularly this year after a really good rise.
Yeah, look, there was a lot in this result. Seek is going to split itself into two. Big news. Andrew Bassett is stepping aside. He'll be running their venture capital sort of business. And the really
good new CEO.
Good new CEO, Ian Narev,
Amazing,
ex-CBA, goes into the group CEO role. And the other big news was that they're selling down their stake in Xiaoping. Now, I think one of the reasons for the pullback is that they're selling it on a lower valuation than most of the analysts thought it was worth. But it's going to leave a beautiful balance sheet, and it's also going to mean that the early stage ventures, which is, I think, the area they're really excited about, a lot of capital to help fund that progress. So.
Which you'll need early on. You need to be well capitalised, and really that's what Xiaoping was for them once upon a time.
Exactly.
So we can see how they know how to find the next one, which is great. So well done to them. Link, interesting. PEXA, maybe we're going to see direct access to that.
Yeah, so and that's been our hope, right? With Link, it's been a frustrating ride. The core business is definitely in recovery mode now after a very difficult couple of years with Brexit and COVID. And the early release scheme that the federal government here put through. But PEXA is the crown jewel of this company, and it is accelerating rapidly with the housing market. And there is now talk that the three owners of PEXA are open to a demerger and setting up an IPO of this business. So we'll be watching this one closely. And there's still a takeover bid in the wings as well.
Yeah, so some upside from both of those things, really. One we've talked about recently, a relatively new stock, Terra, which was a spin-off from Aluka, a pure royalty play on iron ore. Good numbers, but just reminding people there's a nice little yield in that space, isn't there?
Great yield. So this company gets a royalty stream from a huge area of land that BHP currently mines on. BHP is going to triple its production in this area and will be mining on this block of land for at least half a century. So I actually really think, BHP $50, Terra's sort of gone a bit sideways. You're getting the same exposure to BHP's, probably their best iron ore asset, at a much cheaper level, and you get a great yield. They're going to pay 100% through, so it looks really good.
Iron ore prices where they're at now, $175 a tonne, it's phenomenal.
Amazing, yeah.
So really good times there. Moving speed into property, Ben, Goodman Group has been a terrific player in the industrial REIT space, and it's so much more than that, a development stock as well. Maybe contrasting to Lendlease, which has had its own development and construction issues, but at its core actually looks really quite good value at the moment.
Yeah, I think particularly the projects that it's doing, there is a resurgence in the housing market, and it seems to be happening in a number of countries. I think they've still got a great business in terms of the gentrifying big areas of cities, and which is sort of what they did at Barangaroo in Sydney. I thought Goodman's that was outstanding. And they've sort of come off a bit with the bond yield sort of stories, and seen some weakness in the property trusts. But they've really set themselves up for years of growth. Goodman Group.
Yeah, absolutely.
Very well managed business.
Terrific. Woolworths showed its competitive strength and some seriously good numbers. We knew that there was going to be some natural tailwinds there, but there wasn't, when we had Coles the week before, the same sort of negative outlook that we got from Coles, was there? I mean,
No.
Woolworths are aware that they're cycling good numbers, but they were very good numbers and a good outlook, I think.
Yeah, and I think it was a faultless result, really. They, in such a difficult environment, they've executed so well, delivered the numbers, and I think they're in a great position going forward. And the other thing is this endeavour, they're doing the demerger of the pubs and Dan Murphy's bottle shops, etc. And
we told people about on the videos about this over a year ago, but COVID held that up.
yes, because all the pubs got shut down, and so they decided they iced it for a while. But you just so often see with these demergers that the sum of the two parts is worth more than the whole. We saw that with Wesfarmers demerging Coles, a couple of years ago now. That's been a great deal really since then. So Woolworths is in good shape, and prices do start rising. It's a beneficiary.
A little bit of food price inflation, both win in this environment, so it's good. A2 would like a few price rises, I'm sure. But they've been through the wars, haven't they? And, but it wasn't the worst years, and I think A2's outlook doesn't look too bad now.
It's it's a COVID hit stock. The drying up of travel into this country has really dented them. I'd have to say they haven't done well at versing the market up on it. They've probably been too aggressive in terms of the speed of the recovery, and so they've been forced into this. It's kind of like death by 1,000 cuts. We've seen it with a few other companies as well. But look, there's a great brand in there. We know this is kind of a reopening stock now. Once we get things going again in this country and around globally, it should do well. And, there's still a lot of demand on the floor in China. So, I think it looks like a good buy at these prices.
Yeah, again, a little bit like Lend-Lease in that regard. They've been through all the tough stuff, looking a bit of value. Switching to health care broadly, and just to get a stock in a different kind of area of that space and to understand how the different impacts of COVID have happened. If we look at Cochlear, Ramsay, and we look at Medibank Private, we're looking at, a device manufacturer, the private hospital operator, and then the health insurer.
The payer.
The payer, they've been the winner.
Yep.
Not lack of elective surgery have hurt the hospitals and the device manufacturers.
Yes.
But the health funds have had a good year.
They have. Because a lot of people can't pay for the procedures that they would normally be getting done.
And yet the economies have done well enough that they've been paying their premiums. So, however, certainly Cochlear looking really good to me, Ben. How did you read the results?
It was a surprise, surprisingly good, because we thought this was one that would come out, with softer numbers. Like a lot of hospitals across Europe and the US are closed again. Procedures are being slowed up, but despite that, they actually had some good sales momentum. They called out a pretty good year, and again, this is another company that's in the COVID reopening trade, similar to Ramsay. And we know that large areas of hospitals are being set aside for COVID patients, underutilised. Ramsay's had issues with that. But there will also be a big backlog of people that need to get things done that were either uncomfortable or just they couldn't get the surgeon to do it for them. So there should be some pretty good work coming out of this. And again, it's really going to be the vaccine rollout and then state governments being comfortable that hospitals can start to go back to normal operations again.
So a little change again. There was a massive freeze event in the southern states of the US, 1 in a 100-year event. 2 weeks ago.
23 degrees in Austin.
Unbelievable.
In Texas.
And Texans aren't used to the cold, and it caused a lot of impact. So Macquarie Group's got a gas trading business. 2 weeks after giving a quarterly update, they upgraded profit. We believe they made about $600 million transporting gas, and it impacted on the plumbing supplies companies, Reece and Reliance, very positively, Ben.
Yeah, so Reliance is got this sort of fairly new way of fixing busted pipes in particular, but also installing them and consistent renovation. And they have this what's called a freeze event. So when these pipes freeze and they burst, plumbers need to get in, and they've probably locked in their next year or two of growth. This has been an enormous storm. They had issues though actually getting stock onto the shelves because the trucks were refusing to drive into these parts of America. Reece, there's a full-blown housing construction boom happening in the southern states, and Reece is benefiting from that. But we know this will lead to more work. There's going to be sinks and vanities and toilets and all this sort of stuff that needs to get replaced. And that is good for Morsco, which is Reece's Texan business.
Yeah, no, really good for them. Now, just finally, just to reflect on what we spoke about last time, we talked about the bond market. That's now been referred to as the bondcano because of the massive moves the other way in the bond market. So we told you a couple of weeks ago how much the bonds had moved, the 10-year bond had moved up. It moved up even more in the last 2 weeks, and even the last 48 hours.
Yeah.
It's had enormous volatility. It's back down at a more comfortable level in the 1.6 sort of level at the Australian 10-year. But Ben, there's a lot of movement there, including central bank activity.
Oh, it's huge. So, we were watching this at 1.4% when we put the last video out. Maybe refer back to that for an explanation of what's going on. That hit 1.9% within 9 days. It's an enormous move. So this is the biggest bond sell-off since 1994 in Australia. So it's big implications. It's the equity market paid more and more attention to it as the week sort of rolled out. And today we suspect the RBA is intervening in the bond market and trying to calm things down. You've got to put it in perspective. Rates are still very low and the percentage moves are big, but they're off very low bases. But it's more the direction and the speed at which it's happening, which I think is unnerving equity markets. Yeah. And, that has implications for growth stocks, bond proxies, all those sort of things, which we discussed a couple of weeks ago.
That's right, yeah. But it's becoming increasingly relevant. Yep. That will flavour 2021, I think.
Yeah, I think so, definitely.
So it'll be important. Well, that's all we've got time for in reporting season. We'll be back again later in March with another TMS Insights.